Kenya is seeking to stop unsolicited credit health checks by global firms by requiring them to seek regulatory approval before ranking the country's sovereign debt profile or that of its big companies. And in West Africa, the Nigerian exchange has announced it will begin using blockchain technology for settling trade across its platform in a bid to draw in young investors in 2023. And on Tech Thursday, we'll get into how small and medium-scale businesses are putting financial technology to use. This is Business Edge. I'm Tolulokwe Adileru Balogun. Let's start with the African business headlines. Emirates Airlines is stopping all flights in and out of Nigeria effective September 1st, 2022. The airlines explained that its inability to repatriate trapped ticket sale funds from Nigeria led to the decision. At least $600 million of over 20 foreign airlines has been blocked in Nigeria since the beginning of the year. And 2 weeks ago, Emirates said that it had about $85 million trapped in the country. Nigeria's renewable energy sector is suffering from apathy and lack of long-term investments. Genex Technologies Managing Director Patrick Ilo says there are major factors like these hindering the development of renewable energy in the country. According to him, investors still have a lukewarm attitude towards investing in the renewable sector, adding that investors believe the sector is not a profitable venture. Nigeria does seem to be trying to change this by introducing a scheme through the Ministry of Power to attract 0% duty on renewable energy materials. And staying in West Africa, the Bank of Ghana has increased the policy rates by 300 basis points to 22% after an emergency monetary policy committee meeting on Wednesday. The move is part of measures to address the risk to the country's inflation outlook. However, the cost of borrowing is expected to go up significantly and lead to an increase in the cost of living and doing business. And in Southern Africa, Statistics South Africa figures show that retail sales fell by 2.5% year-on-year in June after rising by 0.1% in May. On a month-on-month basis, sales were down 0.4%. Sales in the 3 months to the end of June were up 0.5% compared with the same period last year. And those are a few headlines we have for you. When we come back after this break, we'll get into our first topic. African countries are not happy with the ratings agencies. And Kenya is saying that they now have to get approval to give them ratings. Could this be the beginning of a new wave? Stay with us. In 2020, the COVID-19 pandemic triggered a continent-wide recession, the first in 25 years, and with it came an avalanche of rating downgrades across Africa. 18 of the 32 countries rated by at least one of the three big agencies, Fitch, S&P Global, and Moody's, suffered downgrades that exacerbated their crises. Between 2020 and 2021, 62.5% of rated African countries were downgraded. This was double the global average of 32% and above the average for every other region in the world. 45% in the Americas, 28% in Asia, and 9% in Europe. And for several years now, the global rating agencies have been on the receiving end of criticism of how they rate African economies. And now Kenya is seeking to stop unsolicited ratings by global firms by requiring them to seek regulatory approval before ranking the country's sovereign debt profile or that of its big companies. Could this become the norm across the continent? Ali Khan Sachu, Africa geoeconomist, macro analyst, and the CEO of Rich Management, joins me now from Nairobi, Kenya. Ali Khan, it's good to hear your voice again. Welcome to the show.
Thank you for having me.
So let's start first with this. A lot of people would be curious as to how the rating agencies come up with their rating. So what really is the formula that goes into what we see at the end of the day as an updated outlook or projection for economies around the world?
So basically, basically, ratings agencies have a methodology. They look at overall debt. They look at debt service ratios. They look at the forward income stream of the government. They look at tax collection. It's quite a scientific methodology, and it's not a black box. It tends to be very much in the public domain. You will find a lot of bank analysts predicting ratings, upgrades or downgrades ahead of the official announcements. So, it's not something I think that is a big secret. It's out there. It's in the public domain. And the methodology is fairly empirical and scientific.
So when these ratings come out, how do they in turn then affect the countries when they're released? What do we see with that?
So, first of all, it's investors globally, like pension funds and banks, etc., cannot typically invest without a rating. They're restricted by their trustees. So it's a little bit of a chicken and egg situation. If you don't have a rating, you're basically disallowing a huge investor class into your capital markets. So I think, we've got to be very cautious about how we approach the situation. We might not like the ratings, but I think that would be more call to action for our sovereigns rather than, lashing out at ratings agencies.
Okay, so let's look at the sort of influence, or maybe, again, as I said, in terms of the impact, what actually it means. So in the wake of South Africa's downgrade, around $9.7 billion left the country in 2020. That is about, or even more than 3% of the country's GDP, and the yield on its 10-year bonds rose by more than 100 basis points. For African economies in particular, do you think that these ratings maybe wield some kind of undue influence on investment decisions?
So basically, they have a big influence on investment decisions. You will have funds who can only invest as per certain ratings criteria, and therefore a downgrade might force them to disgorge of positions that they are holding. And I think, in South Africa's case, there's a strong case to say that South Africa's fundamentals fundamentally deteriorated over the period that we're discussing. But definitely, a ratings downgrade is a trigger for capital flight. But similarly, a ratings upgrade would be a trigger, a positive catalyst for cash to come into an economy.
Okay, so let's continue with this. So particularly as one of the impacts, a poor rating means that countries who do go to the global markets for credit don't actually get favorable rates. We can look at Ghana for an example. It's been rated CCC by both Fitch and S&P. And this means for many people, it's effectively been locked out of the global credit market. So if it chooses to get cash, the interest it will have to pay on that money will very likely do more harm than good. So many say that these ratings, particularly when they downgrade African economies, reduces the options that African economies have. So what do you think the options are for countries who are in situations like Ghana when they have to borrow even in those situations?
So you're making a very valid point, and Ghana is a very good example. So what a lot of African countries are doing is avoiding the international capital markets or bond markets as such, and relying on syndicated loans by banks. This was something that was quite fashionable a few decades ago, and it's coming back on the continent. And the thinking is that the banks who participate in those syndicated loans have a much more up-close and personal understanding of the sovereign credit, and therefore are prepared to take the risk, and actually in some cases provide more attractive financing rates. But the challenge for many African countries, of which Ghana is the main example right now, is that we're being shut out of the capital markets. As the Fed has raised interest rates, it's created a sell-off in the emerging market and frontier market Spain. And Africa has become collateral damage in that situation. It's also worth thinking that, we were in a feast. Times were easy, the going was good, we were able to borrow without many problems. We're now in a famine, and everyone is looking at their risk. They are scrutinizing the returns that they're getting. We've had defaults in Zambia. We've got challenges in many countries. And so what's happening is a fundamental market-driven repricing of African credit.
So let's get into this a bit further, because I think we've spoken about this in recent times, particularly with a statement from Ghana's Minister of Finance. But the criticism here is that the rating agencies, especially the big three, Moody's, Fitch, and S&P Global, have been unduly critical of African countries. So in March, Ghana's Minister of Finance, Kan Ofori-Atta, criticized the agencies, saying there is a lack of transparency in their rating methodologies, procedures, practices, and processes, and that they are affecting the prospects of African countries raising the required external financial resources on the capital markets. And now Kenya says unsolicited ratings fail to capture the government's efforts to address downside risk and open doors for unfavorable ratings. Do you think this criticism is valid? Because you also look at the debts, even though there's quite a different dimension to it, the debts held by many Western countries, and they don't often get these downgrades that many African countries are subject to. Is there some form of validity in the criticism that's been coming in recent years towards the rating agencies?
In Ghana's case, let's take that first. The government was reckless from a fiscal point of view. They spent money they did not have. And there is a reckoning for that. And there's been a reckoning for that in the international markets for centuries. Latin America did the same thing, and then had to restructure their debts and had to come out of that. So I think it's a little bit rich for Ghana to be criticizing ratings agencies for what happened under their own agency. Obviously, it is good to have some discussion. It's good to interrogate these ratings agencies. But I think at the moment, I feel that they are a very easy target. And the mistakes are not theirs. The mistakes are our government, who were profligate when times were easy and did not think what would happen if the markets pivoted.
So let me put you on the spot, Ali Khan. So as an economist, how frequently would you say you end up agreeing with the ratings that African countries receive on an average?
95%.
So you think the agencies happen to be dead on the mark?
I think, that they tell unpleasant truths, and we don't want to hear them. And when they tell us pleasant truths, of course, we're very happy with that. But, at the moment, we are suffering the collateral damage from very profligate governments who borrowed money when it was cheap and did not achieve a sufficient return on their investment. And now they're blaming the rating agencies and running to the IMF. But at the end of the day, the fault was theirs.
So let's bring another dimension to this that Kenya has brought. So Kenya had contracts with two rating agencies, Fitch Ratings and S&P Global. However, those contracts have ended, and now Kenya has described the ratings coming out after that as unsolicited, and says because there is no consultation with government representatives, there is an inadequate understanding of the sovereign risk exposure and the government strategy in addressing the downside risk factor. So do you think the ratings being unsolicited or solicited with government contracts in place really change anything? This lack of maybe access to government officials to explain government reasoning, does it change anything when it comes to the ratings?
So I think, the government is clearly concerned about possible rating downgrades. They're trying, I think, to bring some kind of supervision to the ratings agencies. But at the end of the day, without the rating, you're just going to cut off a whole bunch of investors, and particularly when you have more than $7 billion outstanding in the Eurobond market, I think you've got to tread quite carefully. The downside risks exist in all markets, and you can't regulate around your way around those risks. Those risks exist, and ratings agencies are one piece of an equation which includes international investors, domestic investors, all of whom are making a calculation on your credit. So I understand what the CMA is seeking to do. I think, it will be an opportunity to engage with the ratings agencies for both sides to better understand each other's concerns. But at the end of the day, if you basically try and block them off, it's going to be very counterproductive.
So what you're saying is that the drive now, or the plan that Kenya has announced now, asking foreign rating agencies to apply for a certificate of recognition before they issue ratings for Kenya, is something you consider as counterproductive. But do you think, given sort of the sentiments we've seen in recent times around ratings and downgrades on the continent, that you might see more African countries attempt something similar?
Well, I think you're probably going to see African countries attempt something similar because there tends to be a conversation between African regulatory authorities, and I think Kenya might just be pulling the gun first. But at the end of the day, we are participating in the international capital markets in many cases, and it's very difficult, to manage the ratings. And you've got to manage your finances in order to manage your ratings. If you do that, then of course your ratings will then show a much more positive trend. So I think here we've got challenges across the continent, from Egypt to Nigeria to Ghana to Kenya. And I think what we're seeing is market participants and regulatory authorities waking up to the risks, particularly the downside risks, which are out there at the moment.
So as we start wrapping things up, we're focusing on the international or the foreign rating agencies, S&P, Moody's, Fitch, but they're not the only ones who are downgrading African economies, who are providing these ratings. And over the years, we've seen indigenous rating companies also spring up. Do you think there's a difference in how some of these rate African economies? Are they fairer, or is it at the end of the day the same indices that are being looked at and the same conclusions that are being reached?
It's pretty standardized, and you tend to find one sort of level difference between some of them depending upon the perception, but there tends to be a reasonable uniformity. I think, what might be worthwhile doing is something like Adesina at the African Development Bank, looking at creating an African ratings agency. But at the end of the day, that ratings agency will have to maintain its credibility, and I think all our regulators will find that they are facing the same challenges with that. But I think, high time that the continent considered creating its own ratings agency, and probably under the auspices of the African Development Bank.
Okay, Ali Khan Sachi, we'll end the conversation here. I don't think it's one that will end because, unfortunately, African economies are facing a very tough time. So the downgrades and the unfavorable outlooks will continue, and they'll continue to push back on that. And that's probably the expectation there. Ali Khan, thank you so much for joining me. We'll see you again soon.
My pleasure. Thank you for having me.
All right. And this is a conversation, I think, in the past 2.5 to 3 months. We've had this conversation 3 times because African economies are seriously pushing back at the ratings that are coming in from the big 3 credit rating agencies around the world. The effect on their economies is a very serious one. And it is, of course, expected that they would want to get the best out of the markets. And we've seen more African economies having to go to the global markets to deal with their issues. And that's leading to debt. So it's all parts of a larger conversation we continue to have right here on Business Edge. We're going to take a quick time out. So when we come back, it's international business news. And of course, we have more conversations for you. The Nigerian Bourse is looking at employing blockchain technology to bring more younger investors into it. And of course, we also have Tech Thursday. Stick around.